All right, welcome to The Explainer. Today, we're going to trace the journey of a really simple idea, a promise to pay somebody back. We're going to see how that basic promise, something you could literally just write on a piece of paper, exploded into the unbelievably complex, kind of invisible financial system that powers our entire world today.
So, our story kicks off way back in the 19th century. Back then, a financial promise was a physical thing, something you could actually hold. And what's so cool is how flexible it was. A bill didn't need any magic words. As long as the intention to pay was clear, that promise was good to go.
So let's start here. We're talking about the foundational ideas of debt and liability actually being written down on paper. This is how we turned a simple handshake deal into a legally binding instrument.
Now, the core instrument here was something called a bill of exchange, and it was just a simple but honestly super powerful promise to pay. I mean, you can think of it like an IOU that you can pass around. And this was revolutionary, right? Suddenly, a merchant sitting in New York could pay a supplier way over in London without having to physically ship, chests of gold across the ocean. A total game changer.
And this piece of paper had a whole life cycle. First, it was drawn by the person making the promise, and then accepted by the person who was on the hook to pay. Then, and this is the cool part, it could be endorsed, which literally means signed on the back and then passed to someone else, almost like cash. Every step just added another layer of legal authority and trust to that piece of paper.
Well, the system had to be tough, right? If someone just refused to pay up when the bill was presented, you couldn't just throw your hands up. Nope. There was a formal legal process to make sure that original promise was kept.
The solution was this really powerful legal document called a protest. And this was way more than just a complaint. A trusted third party, the notary public, would officially record that the payment was refused. And that single act gave the bill's owner the legal right to go after anyone who had signed it before. It's what made the whole system of trust actually work.
Okay, so how did we leap from these individual paper promises to the massive global finance we have today? Well, in the 20th and 21st centuries, the big challenge became how to manage millions of these promises all at once, at an institutional level. The core idea, the promise, it stayed the same, but the machine built around it got way, way bigger.
In this huge new system, figuring out the price of a promise got a lot more complicated. It wasn't enough to just set a simple interest rate, because now lenders had to think about inflation. So if you lend someone money at 5%, but inflation is running at 3%, your real return, what you're actually gaining in buying power, is only 2%. And that's the real interest rate. It's the true price of that promise. Banks, of course, became the engines of this new machine. And if you look at their balance sheets, you can see how they hold all these promises. The biggest chunk, as you'd expect, is loans. Those are direct promises from borrowers. But they also hold securities, which are really just bundles of other promises, and then they have cash reserves. Those securities are really important. They act as a buffer because a bank can sell them easily if it suddenly needs cash.
And this brings us to the next incredible level of financial engineering, securitization. This is the process of taking thousands of individual promises, think mortgages, car loans, you name it, and bundling them all together. The bank then sells shares or securities based on that giant bundle to investors. It's an amazing way to turn all those loans that are just sitting on a bank's books into a brand new financial product that can be bought and sold.
So, how big of a deal is this really? Well, check this out. Over half, more than 50% of all U.S. mortgage debt is securitized. This isn't some tiny niche corner of the market. No way. It is the absolute backbone of the modern housing market. So what does that mean for you? It means that promise you make to your local bank when you get a mortgage. Yeah, that promise is almost certainly getting sliced up, packaged, and owned in little pieces by pension funds and investors all across the globe.
All right, now we're going to shift gears a bit. We're moving beyond promises that are just about repaying a debt. We're entering a world where investors make some really high-risk promises, all based on the potential to create totally new value down the road.
And this, my friends, is the world of private equity. It's a completely different kind of promise. Here, investors aren't just lending money. They're actually buying a chunk of a company. So the promise isn't about getting repaid. It's a bet on a business plan, on future growth, on the chance for much, much bigger profits later on.
And these are not quick flips. A typical private equity fund runs on a cycle that's about a decade long. It starts by raising a ton of money, spends the first few years buying companies, and then spends the next several years actively trying to make those companies grow before finally selling them, what they call exiting, to hopefully make a big profit for their investors. So how do they actually cash in on that promise of growth?
Well, this chart shows the usual ways they get out. They might sell the company to a bigger corporation, or maybe they'll take it public in an IPO. But look at this. A huge piece of the pie is selling to another financial investor. A lot of times, it's just another private equity fund. It's kind of like the promise of future growth just gets passed down the line to the next player in the game.
Okay, so we've seen promises get formalized on paper, then scaled up into securities, and then abstracted into these big bets on future value. But what's the one legal concept underneath it all that makes this mind-bending complexity even work?
This question really gets to the core of it all, because in modern finance, the idea of ownership isn't as simple as, say, owning your car. Who really owns all that stuff? The answer is surprisingly simple and elegant.
The answer is a legal invention that's been around for centuries, the trust. And it's an absolutely ingenious idea that lets us split the concept of ownership right down the middle into two separate parts.
So here's how it works. You have the trustee, who is the legal owner. They're the ones with the duty to control and manage the assets. But then you have the beneficiary, who is the beneficial owner. They're the one who gets all the profits and benefits. This brilliant legal split, separating control from benefit, is the key to absolutely everything.
And once you start looking for it, you see that this legal structure is the hidden engine behind pretty much all of modern finance. It's what lets a private equity manager, the trustee, control investments for their investors, the beneficiaries. It's how a bank can manage that pool of mortgages for thousands of faceless security holders. It is the basic DNA of your pension fund.
And that, right there, is the big aha moment. This super elegant, really old idea, the trust, is what makes the whole massive, complicated financial machine even possible. It's the legal magic, that lets a single promise be managed and traded and owned by one person for the benefit of millions of others.
So from a simple, handwritten note to a complex digital security held in a global trust, the journey of that one single promise has completely reshaped our world. And it leaves us with a pretty fascinating question to think about. In these systems we've built, where promises have become this abstract, what does ownership really even mean anymore?